Well, hello everyone. Welcome to Trading a Smaller Account. I hope you guys all are fueled up and ready to go. This is going to be a semi-democratic class, so be ready to vote when asked. And today was really frustrating preparing for this class because whenever I saw something that I thought looked interesting and looked behind the scenes, there was frustration ensued. So we're going to talk about that. And I think I'm going to title this class like, is this a rule or a guideline? And my son, and if you've heard this story before, just humor me. But my son was 4. We had moved from the Toronto area to Michigan, and he was in a new kind of preschool class, and he met these two kids that he just adored. And he said, I just thought I'd let you know I intend to marry both Jason, this little boy in his class, and Kelly, this little girl. And I said, this is really awesome that you have met two people already that you like so much that you'd like to marry them, but it's kind of a rule that you only marry one. Like the good news is you've got lots of time to figure this out. And as we're driving up the hill, he says to me, Mom, is that a rule or a guideline? So we're going to talk about rules and guidelines in our trading practice today. And, like you can imagine what the journey of my life has been like. With Connor, he's just such an interesting human being and has been like right out of the gate. Anyway, if you are not following Kevin and I've got Kevin Horner with us in the chat today. He's a friend and a fellow coach. You're missing out, my friends. We're both posting content on X on a regular basis. It's a way for us to communicate with you and you to be able to communicate with us outside of webcasts like this. His handle, Kevin Horner CS, mine, Barb Armstrong CS. So you can also now wander over to LinkedIn and find us there as well. And we're posting content there on a regular basis. So just a quick reminder before we get into the thick of things, we do a lot of options trades in this class along with stock positions, but no options carry a high level of risk and aren't suitable for all investors. We make sure that we understand and define our risk in all of our trades before we place a trade. We're placing all our example trades on the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to learn and figure things out. Make sure you have a plan, that plan's in place. One of the nuances or differences between Paper Money, though, and a live account is that short option positions will never be assigned early. And sometimes we kind of wish they would, and then sometimes we're really grateful that they don't, but that's something that you have to plan for. Okay. All right. So Kevin Horner, if you missed it at the market open, he does a fantastic market overview 4 out of the 5 days of the week, and you're going to want to catch that. So I spend very little time on this section. Where we're going to spend our time is in managing our existing trades. And there was one I promised to look at today, American Airlines. So we'll look at that. And then we're going to place some new example trades. And we're going to look at both the trades we place and then the trades that we decide not to. Okay. Okay, so that's what's on the menu. If you are here for the very first time, thank you for joining us and welcome to this community. We link arms together at high noon every Monday and Friday, and we're figuring this stuff out together. I want to thank the usual suspects, as I like to call them, who are just so gracious at not only welcoming the newcomers to the group, but to just bringing so much positive energy to this class on a regular basis. So to Jay and Will and Sharon and Riceberg and Josh and BJ and Dom and the rest of the gang. Thank you all for being here and continuing to contribute in the chat. Okay, so let's get out to the platform because as usual, I have 10 pounds worth of content to fit into our, 45-minute bag. I have 90 minutes worth and I can't go 90 minutes today. So yeah, here's our S&P 500. And, we are up 10% year to date. We had this huge run to the upside, and then this consolidation, this pennant pattern appears to be breaking to the upside. So even though, today we're down a little bit, one day does not a trend make. We are within a stone's throw of all-time highs on this index. We are looking at a similar kind of chart. The difference is that in this pennant pattern, we're flirting with support. We haven't broken above resistance. And of course, the NASDAQ tech heavy, no financials. And we're on the cusp of earnings season again, so and financials will be some of the first to report. So this index will be less influenced by those because there are no financials in it. When we look at our small caps, the Russell, once again, uptrending. It's up almost 20% year to date, which is quite extraordinary. It's come back to say this 30-day moving average and seems to be holding its own, even though it's down just over 0.5% today. Again, the uptrend is still, at this point, firmly intact. And then when we come and we look at the Dow, when I looked at this first thing this morning, it was actually up. So I looked at some of the stocks in the Dow, but again, it looks like maybe a bit of a bull flag setting up here, and within a stone's throw of all-time highs. So bullish everywhere we look, in spite of the fact that there's some, red on the charts today. And our volatility index at 16 is at the lower end of the range of where it has been year to date. Okay. Now we have one trade that has hit a target since we last met, and that is Cisco. So let's start with Cisco. I was going to say today is brought to you by the numbers, 1, 4, and 5, because we want to review the one trade that hit a target. We have 4 to manage, and then we have 5 new examples that we want to look at. So here's Cisco. And that's our 1. And Cisco, we had a short put vertical here. And, at 112 and 111. And Friday afternoon, if we come over here, this hit our target. Oops. And so we sold this for 28 cents back on June 29th. And on Friday afternoon, around 1:18 Mountain Time, it closed out for a nickel. And that was, what our exit was put in at. We had said, when it's worth a nickel, please buy it back. And it was bought back. So what did we make on that trade? Well, we made, and this will be the, whoops, can you tell I was posting on X this morning? So we take our 28, we minus our nickel that we bought it back for. So we ended up netting 23 cents a share, or $23 a contract. We did 6 contracts, so we would multiply that by 600. So we made $138. And, that's a base hit. And you may say, well, that's not taking me to, the Virgin Islands and drinking something out of a coconut. No, but, that puts a dent in a grocery bill if you were looking to generate $100, and our goal is to generate $200 in income a week. That was our goal for this class this year. And, as we've seen, some weeks we way overachieve and some weeks we way underachieve. But if you're looking at return on risk, this was a dollar-wide spread. So our risk was 72 cents, which was the dollar spread minus the 28. And we made 23 on our 72. So it was a 32% return on risk. Let me just double check that. 23 divided by 72. Yeah, 32% return on risk. And again, that one kind of went exactly according to plan. Okay, base hit. That's what we were looking for. Okay, so let's move on. I want to look at one trade. Yeah, somebody said, yeah, that's a nice evening at the ballpark. Yes, it is. So we have some buy rights, and let's look at those, and then we'll go place some new example trades. And so here is, we have 4 buy rights in play. And I want to discuss, because when you come in and to do your daily review, we have 2 that say in the money. And anything that says in the money, we're going, okay, we're sitting up and paying attention. So here is Fitbit. The most we can make on this is $55, and we are at 54.53, and it expires on Friday. And so my question is, do we take the money and run? The most we can make on this trade is 187, and we are at 141. So if I take 141 and divide it by 187, that we've got 75% of our max gain. And the way that I got to that 187 is I said, okay, we paid 53.13 to get in. And the most we can make on this is $55. If we're called out at 55, it's trading $2 above that. But and this is one where if we were called out, so I'm going to just do a little survey in the chat here. I'm going to start a poll and say Fitbit. So we have a number of choices, but let's say our choice is take the money and run, or wait and with the expectation that we'll be called out. And I'll go with whatever the group decides. And we're meeting again on Friday and Monday, so we'll see how that plays out. Now I'm going to make an executive decision in the interest of time. On CSX, and one of the ways I know this, and if you're saying, how does she know this? We can tell that this was the original trade we placed because it's showing as covered, and it's done the math for us. With this one, it's showing 100 shares of stock and then a covered call. And that tells me I sold a call before. And we did sell a call before on this one. And so what call did we sell? We sold the 50 call. We sold it for 60 cents or 65 cents. We bought it back. We made $45 on it. We bought it back for 20. So we've made just over $200. We made $45, not counting transaction fees, $45 on the first one, and we're at 154. So that's $200 on an initial investment of $46.97. And so if I say, well, you're saying like $200, like she's doing like, nickel and dime stuff. Like, guys, like we started this account with 25,000. So, a $250 gain is 1% of the original total account value. So that's not too shabby. So if we say, okay, let's just say we made 200, we're live in the market so that things keep changing, divided by 46.97, that's about 4%. So if we say, okay, well, 4%, that's not bad. And sorry, I didn't run that properly. If we made 200 divided by, I have to take the decimal out, 46.97. That would be 4.25%. And when we placed this trade, we said we'd be happy with a 4% return. And again, we could wait to be assigned because this is at 47.50. So here's CSX. And it's at almost $50 now. So we could just wait and be assigned if we don't need the money. Okay. And we'd have a little bit bigger gain, because we could still make, again, this, if we're called out at 47.50, there is a little more money still on the table. Okay. So, but I want to show you how to close this out. So we're going to take this money. Okay. And we're just going to close it out. And we do have earnings upcoming. And one of our guidelines for this is we're trying to kind of sell something in momentum, get it run over, have it be called out or exit it. And we don't want to be in this over earnings, and earnings is coming up. So we're going to come to our working orders for CSX. And we are just going to cancel this. I find this to be the easiest way to do these buy rights. And then now that that's canceled, we can see there's no chiclet beside it. I'm just going to highlight the whole thing, right click, create a closing order. Now, if it didn't give me a closing order to both sell the stock and buy back the call at the same time, we would buy back the call first because we don't want to risk having a naked call. But we're going to just close this all out at the same time, confirm and send, fire in the hole. Okay, so that's CSX. I'll make sure that gets filled. Fitbit, the vote is 83% to close it out. So again, we're going to come up to our working orders. Fitbit, we're going to cancel that. We're going to come back and we are going to buy this back. So we're selling our covered Fitbit, exiting the entire position for 54.50, fire in the hole. Okay, now the last one in this group, or sorry, American Airlines. I might have said United Airlines earlier. So American Airlines, if we look at American Airlines, we sold our call up here. We bought the stock and set this trade up on this day, and it's now kind of pulled back a bit. So if we come and we look at American Airlines, this one is worth virtually nothing. So we could just let it expire worthless, or we could say, you know what, we'd like to just close this out. If we can, oh, not the whole thing. So we're going to come up here again to American Airlines. We're going to cancel this. And then we are going to come back to our position and we're going to buy back this call. You know, we'll give you 2 cents for it. And then if we wait for this bounce, and it may not bounce. So we're going to put, and I'll do this. I'm going to take and put a stop, say 3% below this recent low. And if it continues to go down, we may say, hey, we just want out. Or if we wanted to be in this longer term, we could use this 1529, which is, I think, what we probably used, you know, in the first place. Okay, so, but we've got earnings coming up on that one too. So that's that one. Fitbit, we've exited. I have one other one that we want to look at, but let's go and look at some new trades. And I thought we'd look at Uber. I take a lot of Ubers when I'm traveling with Schwab. So this stock, you know, we can see by the 100-day moving average that it has been downtrending, but it's kind of hit this bottom, and we now seem to see this support level around this 69 level. And then it's had a bit of a ceiling with one exception where it tried to break out and didn't quite make it around the 78 level. We do have earnings coming up on August 5th. And I was thinking credit spread sandwich here. You know, most people, you know, the official term in the industry is an iron condor. And I was thinking, like, could we just do something that expires prior to earnings and sell a short call vertical here, where the expectation is that it will stay below 78, and then do a short put vertical here with the expectation that it will stay kind of above 70. And as long as it does that and it doesn't squish out and get our hands dirty, you know, we would have a profitable trade. So we're going to go and look at, you know, if that would work out or if it's even a possibility. So when we come to this, we're looking for something that trades 1 million shares a day or more. Does it? Yes. When is earnings again? Earnings is the 5th. So that means if we want to be out prior to earnings, we'd want to, you know, do this July 31st if we wanted the expiration date before earnings. And then we wanted it to be 78 or above on this side. So then, you know, do we have lots of contracts? Do we have a tight bid-ask spread? We do on both sides. So we're going to come out here and say, okay, we'd want to do the 78, and we're looking at selling an iron condor. So 78, we're going to make it $2 wide. So 78 and 80. And on the, oh, sorry, 78 and 80. And then on the put side, we don't want the 77. We actually want the 70 and maybe the 68. So $2 wide. So we get 83 cents on a $2 wide spread. And if you say, well, 80 cents, like, and we come down to this 70, we have a delta of 17. What it's saying is you have an 80% probability of it expiring worthless. So those odds look not too shabby. And up here, the odds are not as in our favor. We have a 68 or 67% chance of it expiring because this is probability of it being in the money at expiration. But if we're looking at our chart and saying, well, our technical analysis, leads us to believe that it is likely to stay below 78. So we're willing to do this trade. So the next question is, well, is 84 cents a contract enough to wet our whistle? So, and we want it to be, if we're in this trade for 18 days, well, at a minimum, we want a 20 to 25% return on our risk. So 84 divided by, we're risking $2. So that would be $1.16. It can't be 72%. It's about less than 50. 84 divided by 116. Well, 70, it's saying it's oh yeah, because we're risking, yeah, that's a 72% return on our risk. Like, well, that meets our criteria. And so if we say, well, if we're risking $1.17, we could do like 4 of these. And if we did 4 of these, how much are we risking? We're risking $468. We don't want to risk more than 500, so we're good to go. And what we're going to do is put in a first trigger sequence and say, hey, we want to buy this back when the whole thing becomes worth 16 cents, when we've got about 80% of our max gain. Or we could make it 17 cents if I'm rounding up on that 3. 17 cents. Good till cancel, confirm and send. We're going to put this in our Iron Condor group. Okay, so that is Uber. Let's look at Paychex. Now, Paychex has already had earnings. It had earnings back here. It was going sideways forever and a day. And then, so we kind of had this, if we're playing I Spy with my little eye, a bit of a double bottom or a triple bottom here. Or some might say, you're seeing that, but I would call this part here a cup and handle. But regardless, it broke out, it came back for a couple of days, and it's now on its way again. So it's like, well, this might, have some potential. Like, let's go look at the trade tab. And, maybe we could do a long call vertical on this. So we're going to come to the trade tab, and it only has monthlies. So if we look at this and we say, well, we're just at 110 right now. I wonder if we could do the 105, 110. We've got 400 contracts. It trades probably 1 million shares a day or more on average. Yeah, we're early in the day. So yeah, 2 million. Yeah, so we're good on that. Is the bid-ask spread acceptable? Well, at 50 cents, we're kind of at the wide end of the range. And this is 2 to 240. We don't want that to be more than 20 cents. And right now, bid-ask spreads are higher, but when you do a vertical, it tends to fill at the mark, is the way that they fill it. And I don't know if we get that in paper money, but when we look at these things, these are considerations. And so could we get enough for it to be worth our while to consider doing something when it's already through the strikes? And this is kind of a less directional way to do a long call vertical, because as long as it stays where it is or above, we'd have a successful trade. So if we said, okay, we're willing to do that, and at 255, what would be a 50% gain? At 382. And you know, we could make 245 on this, but we don't want to be greedy. We're saying, hey, you know, if we can make a 50% return and we're still leaving, you know, 100 and some dollars a contract on the table, we're okay with that. You know, we don't need to get all of it to be successful. So we're going to do 2 of these. We're going to right click, first trigger sequence, opposite order, and we're going to make this 382. Good till canceled, confirm and send. And we're putting that in our long call vertical group. Okay. Now, what if we had said, looking at this chart, what if we wanted, you know, to come down and say, well, our low here is say 103. Like, could we come down and do a short put vertical around 100? And when we have this wide a bid-ask spread and this modest a number, we know that there's not going to be enough premium in it for it to be worth our while. And you might say, well, what about doing the 105? But you know, your delta here is 30, and you've got to be sure that you're making enough of a return on it. And you're saying, well, that's 112 divided by what, 388? Like, that's not too bad. But because this one only has monthlies, that's a 28% return. And we'd be coming out for 39 days. And our guideline in our example trading plan for short put verticals is if we're in it for 39 days, we want at least a 39% return on our risk. And we're not getting that. And so doing a short put vertical wouldn't be a possibility because of that. Okay. Okay. So that's that one. Let me look at some of these questions. Take the money and run. Yeah, on Fitbit, like, why not just get assigned? And we could do that. On both CSX and Fitbit that are in the money, we could, with those buy rights, allow ourselves to be called out. And if we were in a live account and we were called out ahead of time, would we be sad? No. We'd be doing the happy dance because we've just made our max gain and we didn't even have to stay until expiration. Yeah. And you know, can we roll calls? We can. You know, and somebody's saying, can we roll the call on American Airlines? So let's have just a teensy conversation on that. So here's the dealio. We bought back this call. We're buying back this call today. And, you know, it expires Friday and it's worth ding qua qua, like it's worth almost nothing. Well, in fact, the thing said it was worth nothing, right? So we could let it expire, but let's say it bounces and we get to earnings and it's come back up close to this 19 range. We already own the stock. Why not wait and sell the next call when it's up closer to this resistance level? And so that's why we're not choosing to roll it. If I had 282 rather than 382, the number would be even worse. On paychecks, like the bigger the denominator, the lower your return is going to be. So paychecks of it, 112 divided by 382. Sorry about that. Yeah, 29%. But you know, we wanted 39%. So I guess I did it right. Somebody's asking why I chose Uber. Yeah, and somebody questioned, like I was a little over 500 because we're up. We started with 25,000, and in this example account, we're now at 31,000. We're willing to go maybe to 550 or 560, a little over. But if you don't want to, provide any leeway there, but we won't do 600. Okay, so somebody asked why we chose Uber, because when I looked at Uber, it's been going sideways for such a long time. I thought this might be a nice opportunity to do an example iron condor trade, because I know there are people that are fans of it. And the iron condor trade, what is so delicious about this trade is that you're doing basically two credit spreads, right? You're doing the short call vertical, and we're risking $2 on this side, and then we're doing the short put vertical, and we're risking $2 on this side. And do we know where it's going to end up? Like, we have a successful trade. It can go all the way up to 78. It can come all the way down to 70. So it's got lots of wiggle room. As long as it stays in here, we're successful. But one thing I know for sure is come expiration day, it cannot be both through these strikes and through these strikes. It can be one or the other. So we're collecting two credits, cha-ching, cha-ching, for one $2 risk. And so that's why some people like this strategy. And I can see the appeal, but with the markets being so bullish, we're not, the number of stocks that are in this category is less than it might be if the whole market was going sideways. So yeah, like we've done several long condors this year. Oh, you're saying a long condor. No, we've done primarily short iron condors, but maybe we'll talk about that in another class. That's a different idea altogether. It's kind of the opposite. Okay, so that's Uber. Let's come and have a look at Caterpillar. Well, actually, you know what? We've got almost 15 minutes. Let's do the one thing that, we're kind of doing the gallows walk on. Well, you're not doing the gallows walk. I'm doing the gallows walk. Okay. So we'll get rid of these to just get rid of our distractions. So we have a short put vertical with one of these deadly little in the money signs. And I don't know if I put this in error. Like, we're risking over $600, and we don't take that amount of risk. So there was a mistake in placing this trade. Because we broke our position sizing rules. So I'm going to say that right up front. But we're down $500 on this, but we're at 842 to buy it back. Max loss would be $10. And this was something that kind of blew my mind when I first started, was that I thought, well, if it's below both strikes, then I'm at max loss. And the strikes are at 250 and 240. So I usually just put in the top strike. So we're through both strikes, and we're still not at max loss. Sorry. I just want to visually show you where the other strike is. So, but it's now the Monday before expiration. And, when we looked at this, I looked at this last week, it looked like it might be bouncing, but today it's moving on down to the downside. So we need to admit that this trade did not go according to plan. And the closer you get to expiration, the higher the probability that this may be called out. And that's a $25,000 position on Marvell. Because when we sell a put, we're saying, if you'd like us to buy 100 shares of Marvell at 250, we're all for it. We're willing to do that. You can't go like, oops, JK, I didn't really mean it. So we're at risk of assignment. So to avoid that pickle, we are going to come into Marvell, and I have these listed alphabetically, and we had hoped to buy it back. Our intention was to buy it back for 69 cents. We're going to cancel and replace this one. It's like, okay, 853, and we'll give you 855. We need to exit that position to avoid ending up in a bigger pickle. Now, what if you were assigned? What if you woke up this morning and you had an email or a text saying you've been assigned? Well, then what you would do is you would go in and exercise your right to sell that stock at 240 that you just bought at 250 because it's currently trading at 219. Okay, so that's that one. Okay, so that's all the trade review we're doing for today. What spreads did I do? So Trader Joe, are you asking me what we've done so far for new trades? For new trades, we've done an iron condor on Uber. And now we're going to come and look at Caterpillar. So Caterpillar, we had done a long call vertical, which worked out really nicely. So we can kind of take that off. And, then it kind of pulled back, right? So we can get rid of those. It's pulled back, but the trend is still intact. Like I heard somebody say, this is an industrial stock that is moving like a tech stock. Like it's up 61% year to date. The uptrend is still intact. It still looks like a bit of a bull flag here. It's pulled back kind of to this previous resistance level and seems to be kind of holding its own. We have earnings coming up. But if you're really bullish on this, and this is one of those, is this a rule or a guideline? So we broke our rule on Marvell and that cost us. And I think that was just a mistake because we would normally, when something is a $10 wide spread on a short put vertical, we can't trade it typically because we can't get enough of a credit to offset the potential total risk. So with CAT, like this is a $900 stock and we have earnings coming up. And so when this is, with a short put vertical, we have a disproportionate amount of risk. Often we're taking 2 or 3 times the risk that we compared to what we can make. We can make $1.50, but we're risking $3.50. Or we can make $1.20, but we're risking $3.80. And so we don't want to take that risk over earnings when something could gap down. But if you're looking at like a long call vertical, or could we do this if it's August 4th, if there's enough volatility in the market, could we do something where we're out prior to the 4th? So that would be only 18 days. So time decay is really going to be amped up. And then do we have lots of contracts? Well, we've got dozens of contracts in this weekly. And where would we want our strike to be? Well, we'd want it to be below, say, 925. So if we came to, well, we could do the 920. So if we look at this 920, oh, this has come back. This was up, like this was up when I looked at this, and it was a Harami pattern and looked like it's holding its own. This has come down now, and now it's trading at 125. And then when I come here and say, well, if I were to do this, but that candle no longer looks interesting enough to want to place that trade, if we look at the 920, we've still got like a $3 wide spread, just less than that. So we haven't, the bid-ask spread would allow us to do this, but now this candle would say, I think you better hold your horses. And so we may on this one just decide to wait to just confirm that this support level is going to hold. And so with this one, you might say, first thing this morning, this looked more interesting because it opened here, and at one point it was trading up here. So it was a bullish candle, but that interest is now waning. And so we're going to take that one off the market. Now, if we had a bullish candle on this, could we say, hey, we have earnings August 4th. but we've done some research and we're overall bullish on this. Could we do a long call vertical out to the middle of August? Yeah, and like Sam is saying, your if we come out and we look at the August monthlies and we look at these long calls, this is a lot more interesting. But look at the bid-ask spread, 52 to 58. You could drive a truck through that. So even if today's candle was bullish, this bid-ask spread, this does not meet our rules. Now, we probably wouldn't want to do this one. We probably want to do the 920, 930. But so these would meet our bid-ask spread criteria, but the candle doesn't. The setup on the chart no longer matches. And so this is kind of one of those, is it a rule or a guideline? Well, we don't have permission on the chart. Now you might say, well, I think it looks good. Well, then you place that example trade and we'll see. Now, if we had placed that trade on Friday, we might still be in it. We wouldn't exit it based on this candle, but we won't place the trade based on this candle either. Okay. Let's look at IBM. And as many of you know, I spent a decade with IBM in Toronto as a marketing rep and a systems engineer. But we have, July 22nd. So earnings is right around the corner. And by right around the corner, the 22nd is a week from Wednesday. So could we do like a 1 ATR move if we're thinking and let me just back the truck up a bit. It's been hitting this resistance level around this 316 to 318-ish, 316 to 320. But it seems to be setting up a bit of a cup and handle pattern. Today, we've got this Harami pattern, bullish Harami, or an inverted hammer. But this bullish Harami, this inside day, now this candle is live, so it can change. Yes, I had 3 blue suits actually. I worked in banking. So for a conservative company, like the banking teams in Canada are huge. Even the smallest Canadian banks would have well over 1,000 branches. Yeah, so anyway, I digress. But so let's come out and look at, could we come out, and we'd want to come out to August to give us more time. And then it's like, okay, this is almost a $300 stock. I want to do a 1 ATR. And so here we've got 95 cents on a $2 option. The problem is when I buy a call, I'm risking $1,900 to $1,995. I can't risk more than 500, maybe 550. So I've got to go out here to the cheap seats. And when I first looked at this morning, the bid-ask spread was insane. And so I was going to make the point that this may look appealing, but we can't place the trade because the bid-ask spread is too wide. Now the bid-ask spread has settled down and it's okay. And you're saying, but you are so far out of the money, you'd need binoculars to see it. And look at the delta. And what does delta tell us? Well, delta tells us that if IBM goes up by $1, then the value of this option will go up by 20 cents. So, on $5, 20 cents, let's just round and call it $5 to be in the middle. So 0.2 divided by 5, that's 4%. It'll go up by 4%. So, but if we look at this will go up by 47 cents. If this option goes up by $1, and let's call this $15 just to make the math easy for me. So 47 divided by $15. That's 3%. So we actually are getting a better percentage return. And because we have earnings coming up, we can't really afford to do a long call vertical, but could we do like this little swing trade, just back up to this, say on this one, where did it close? It closed at 306. So from 291, let's call it 305, do this little swing trade with an option. And we're going to watch it because we want to be out prior to earnings. Okay, so we're going to make our target, say 305. And this is a swing target. Now, the advantage of this over a 1 ATR trade is the way we manage the exit is if this option loses half its value, then we exit the position, as opposed to the 1 ATR. But the average amount this IBM has moved over the last 14 days is, $12.25 a day. That's the range. So we're looking for this to go up from 291 to 305. So or 292 to 305, about $13. That might only take 2 days and it might never get there. Yeah. So Grace is asking where you can find the rules. I paid Grace to say that question. No, I didn't pay you, but I'll show you in just a sec. So let's go in and place this trade. And this is a way of trying to tiptoe through the earnings tulips, if you will, because we've seen, a previous earnings where it gapped down, the last earnings it gapped down, and then on this earnings it gapped up. So we know it can be a gappa. And then on this one, like it opened lower, rallied dramatically, and then continued to move dramatically to the upside, gap down. So if we don't want to play the gap game, we want to place a trade where we'll be out prior to earnings. Okay, so that's what we're going to do. We're going to come to the trade tab. We're going to do what we can afford. So this is a strike selection based on, it's like if you go to a restaurant, you're on a budget and you order based on the right side of the menu. Yeah, that's what this is. This is a right side of the menu selection. And actually, I'm going to change this. We're doing buy custom with OCO. And our target is going to be a market good till canceled. And we're going to hit our sprocket to bring up our conditional order and say, hey, when this goes at or above, was it 305? We picked? I didn't write it down. 305. Oh, shoot. We are over time. It's 2:05. Okay, so I'm not going to be able to walk you over there, but go to the trade management mini sessions. It's a playlist. You'll want to subscribe to the channel. And our exit is going to be at 2:55. Okay. Make that good till canceled. Yeah, and I've got example trading plans for all of these strategies except the iron condor in there. And this is a long call. And this is a swing target. So guys, hit the like button, subscribe to the channel. If you haven't done so already, follow us on LinkedIn and X. And thanks to Kevin and the guys behind the scenes, and have a great day. Take care, everyone. Bye for now.